Welcome to Wander Financial. Today we're discussing options, and in particular, call options. Call options give you the right, but not the obligation, to buy 100 shares of stock at a certain price, at a strike price, on a certain date, an expiration date. So, let's take a look at a chart here of X, United States Steel. In this case, we might think the stock is bottomed and is going to head up here to about $19 over the course of the next few weeks. So let's bring up an option chain. Okay, so we have two things we could do. We could just buy the stock. If you bought 100 shares of stock, that would cost you $1,507 right now at the current price of $15.07. But if you want to trade with leverage, you can buy a call option. If you buy one call option, that will give you the right to buy 100 shares of stock at $15 at a specific date. In this case, this is the August 2nd expiration date. That's just a couple weeks out. You would probably want to go further out than that, but just for explaining this, we'll look at these. So $75 you would pay. That's 75 cents times 100 shares. $75 is what you would pay for one call option. If the stock goes up to $19, that would mean the $15 call options would be worth $4 at expiration. It would be your profit then would be $4 minus the 75 cents, so $3.25 times 100 shares, $325 you would make. Now, if the stock were to settle on August 2nd below $15, then your calls would be worthless. So you would lose the full 75 cents. $75 is what you paid for them. So you can see a little bit of how leverage works just by doing the basic numbers here. If the stock went down to $12, the thing is with calls, I guess, is if the stock settles below 15, it doesn't matter if it settles at $14.90 or it settles at $10. Either way, your full risk is the $75, the 75 cents that you paid for your one call option. Okay, if you had bought 100 shares of stock and the stock went down to $10, you would lose $5 per share. Right? And if it went down to $14, you'd lose $1 per share. So that's kind of the difference here. The nice thing about buying calls is you know your risk. It's stated. That's it. You can't lose more than the premium you paid. Meanwhile, the upside is unlimited. The stock could go, could go up to 20, it could go up to 25, whatever it is. So the basic idea of buying a call is that you are gaining leverage and you are expecting the stock to go up. And we're going to talk a lot more about options. There's a lot more to learn, but that was a very basic explanation of a call option. Thanks for watching.
Thanks for watching, and don't forget to hit that subscribe button.